our model's efficient, our approach is efficient, we understand what the credit risk is, and but we can't offer you a discount anymore because no one's funding that. That's okay, and you just have to pivot a little bit. So I think it's really important to break it between the two, and not to sort of lump, we are nonprofits, therefore we get grants, therefore we're not going to argue about how we're using subsidies. I think you have to break it in two.
I'd like to address the pricing, not necessarily for the borrower, but pricing for the product of let's just say, a platform or a decision-making tool like MMS. It was our experience as we started going out into the marketplace to provide this service, the local practitioner didn't want to pay for MMS. So that was another challenge as well in our community. So why, gosh, let's go out and find a grant. We would ask people then, well, can you go out and find a grant then to pay for MMS? So I guess, sometimes I think about it as we have the not-for-profit mentality, and then at the same time we are business related. We're financial institutions without depositors. So it's always, we live in a schizophrenic world sometimes. How do we make ends meet? How do we serve? And I want it for free. So I don't know. We've got to think of other ways of doing that so that we can make this thing work.
No, and I think you talked about the subsidy and the subscale, and I would like to relate to experiences here. One thing I would like to say that micro lending or the CDFIs in US have been very subscale. The whole rise of MCA industry in the last 4 years has been because of the fact that CDFIs haven't been able to scale up, their businesses. There are a lot of businesses who are taking the MCA loans because they cannot get more reasonably priced loans at a speed that they want, actually. The second thing, my experience has been, we have worked very closely back in my own country, India also, and I've seen microfinancing can be scaled up if the technology and the whole financing comes in. So why do every microlender in this country has to be non-for-profit, They could be for-profit, but with a mission-based kind of a charter, so that's important, I think. So that, people should think like that. And I think the third thing is that what I very strongly feel is, and that's one reason why Biz2Credit has never gone into lending through our own balance sheet. And a lot of people have asked me this question because we firmly believe that we are a technology company, we are a credit scoring company. And the key thing is that as CDFIs, they should be more looking towards how to make the process faster, simpler, cheaper for themselves, but also less, say risky for everybody else. And a lot of CDFIs I find, they are obsessed with saying that we will develop our own, say, technology platform. Because I think the technology is changing so quickly right now. It's like, it's almost impossible to keep pace with that and trying to say that I will lend and I will build the technology and the platform. Because then you build a subscale platform and you spend a lot of money in doing that, and then you're not able to, keep pace with that. So I think those are the key observations. And I've seen the subsidy should be more towards, developing and sustaining the ecosystem. And even if you don't give any subsidy on the interest rates, if you are a good loan performance portfolio, you can credit score it well, you can lower your internal cost, you will be able to pass on those savings to the customers. And the customers in this country, the small business owners, will still get money at a cheaper price and longer term than what they are borrowing today, And coming from India, I see the capital markets in US are so deep. And this question baffles me, that why business owners here are forced to borrow money at 30 to 50% APRs, while in some of the developing countries with no credit data, very little money, these micro lenders have scaled up and their APRs are only 24 to 26%, out there. So I think that's a question that I think you guys can answer better than me, actually.
Thank you. I think that was a helpful discussion. James, you mentioned earlier technology, in your view, is the great equalizer. And knowing that whoever speaks first seems to have some advantage in responding to the questions, let me start with you. So given technology as a great equalizer, one of the challenges that we hear in microfinance is that it's very costly. Could you talk a little bit about how your technology and some of the innovations that you all have done have helped to bring down defaults, bring down the operational costs, and maybe even expand on how that is then manifesting in some of the work that you're doing with CDFIs in the pilot effort that you're running?
Sure. So, giving you a little bit more background about sort of the OnDeck platform, and then really the OnDeck score, which is, if you think about FICO for an individual, the OnDeck score is really the same thing for a Main Street business. You know, we had the same problem when we started OnDeck, which was we were looking at a stack of paper and then trying to figure out from that stack of paper, how do you maybe build a scorecard, and then how do you add a little bit of the art to the science. And what we started on was basically saying that's not going to work. We have to digitize and translate all of that paper into raw data. And that was sort of the beginning journey. And then we had to start building models off of it. And sometimes I think technology can sound sort of very mysterious. It's not that mysterious. It's very good at saying yes and no when you run models, and it's not very good at maybe. So we've built a platform that has a lot of people to support the technology whenever a maybe comes up. And that can be at the very beginning of your process, and it can be at the very end of your process. And then what we've built on top of that is continual improvement to actually get more granular and more granular data. And to give you an example, all of you probably work with the credit bureaus and get bureaus. How many of you, when you go to a credit bureau, are getting a PDF statement or a paper-based statement back from a credit bureau? Okay, roughly half, and I think there's some non-lenders in here. I think that's in today's day and age very inefficient. If you think about that, that's 5-6 pages. There's probably 500 different points of data on there. It's incredibly time-consuming and an incredibly incredibly hard problem to really understand in depth what that means. So, you know, we've gone to the bureaus and we get raw data. And even if you go to the bureaus, they say their data. It's not data. It's actually summary variables on top of data. And so we've gone to the bureaus and said, we actually don't want that. We want the raw data. Because, you know, the credit bureaus are trying to protect what they have, and actually the raw data, if you build a platform that can handle it, is actually the most powerful thing. And so what that means is when a small business comes to us now, we're looking at over 2,000 data points in real time, and that accumulates itself in the OnDeck score, which you know, really tells you what's the financial health, what's the creditworthiness of this small business, and then you can design products around it. And so as far as what that means for sort of pricing and the overall market, if you have a system that's that granular, you can be incredibly transparent. And I think that there's a conversation that needs to happen around pricing. 50% of our borrowers, Mitch sort of mentioned it before, we've lent over $1.1 billion to date. We'll lend over $1 billion this year. Our average loan size is just under $40,000. But more than 50% of our borrowers choose to take less than the max term we've offered. So we might offer them a 12-month term, and they say, wait a second, I'm buying inventory. I only want to take that for 6 months. That's going to lower the total cash cost of the loan. It's going to dramatically increase the APR on the loan. And they don't think about it that way. They think about what's the right return for my business, what's the way to minimize the cost to me. So I think that what technology can do is it can let you be very transparent. It can make you make those trade-offs very easy. When we're talking to a customer, our service reps know exactly what the options are because it's in front of them and it's technology-based. They're not trying to figure out, okay, what would I have to do if I wanted to go from 12 to 6 months, or 6 months to 9 months, or if they want to reduce from a $75,000 loan, max loan, to a $35,000 loan. It's all in front of them. So it enables them to have a very productive conversation and ultimately put the power of choice in that small business owner's decision in their arms. And we think that that's the right thing for businesses, whether they're getting that loan, quite frankly, from a for-profit or a nonprofit lender.
Janie, could you also talk a bit about MMS and how it, in your view, has helped both Acción Texas and other users of the system with respect to costs associated with defaults or operational costs?
Mm-hmm. I would say before MMS, our decisions were in the gray area, and it was very, up to the loan officer locally, and there really wasn't strict underwriting, right? And so after MMS, the gray area went away, and so it is actually helped in terms of keeping defaults at a lower scale. And so as we offered it to other folks in the community, in the CDFI community, what happened is that there was no longer a need for underwriting at the local level. There's still going to be eyes. The MMS user makes the final decision because it is their portfolio that they are handling, but the recommendation is coming from the platform or the software. So what happens is, for example, in Puerto Rico, when we went and started the program, helped them get started there with MMS, their board of directors were also in the room. And so as we explained to them how MMS worked, the board of directors says, wow, we don't have to meet every single week to review these files. And we said, no, you don't. And they were relieved. And they said, they left the executive director in the room and said, we're leaving now, thank you, bye MMS, you know? So it's those kinds of efficiencies that now take place because decisions can be done much quicker. And so the good news is, yeah, you don't have to have an underwriter locally to make these decisions. The bad news is if you have an underwriter, what's going to happen to the underwriter? You know, and then also the fact that the folks that you have on the ground have to have that sales mentality. Now it's no longer let's wait and, you know, for people to come in and let's see if they want to apply. Now the mentality is sales. You know, Jarrett, who is our loan officer here in New Orleans, that's his forte. He's a sales guy. He's out there talking to people, going to chamber events, going to different community events, going to church events, talking about our product, right? Our products. And so then he doesn't have to be an underwriter. He helps the customer fill out the application. It goes online. It goes to San Antonio, and Nellie and her team do the underwriting, and Demo, who's here, is an underwriter as well. You can talk to him. And then it comes back as a decision. So we can spend more time than on trying to reach more people rather than having to make all these decisions.
Rohit, I'd like you to address the same question, but also in our discussions last December as we were working on the report, one of the things that struck me that I'd like you to expand on for the group is with your platform, some of what you do, and not just helping to reduce costs through technology, but also looking at some of the data and then going back in partnership with some of your clients who are lenders to identify you can streamline all of your data requests. Some of these are not affecting the decision. So if you could expand on that conversation, I think it would be useful for the group.
Yeah. So I think what we have done over the last 5-6 years is we have our own score, BizAnalyzer score, which takes into account your FICO, your cash flow, and everything. And what we do very extensively now with all our lending partners is that we have a marketplace, so we have underwriting criteria for all our lending partners, and we try to benchmark both the portfolio performance and the underwriting criteria. And then we go back to our lending partners and tell them that how they can streamline the processes. They might be asking for too much data or too much paperwork initially. That's how it started, or right now too much of data. As James said, we pull a lot of raw data. But on top of it, also look at things they might not be looking. So like one example I will give you, this year was harshest winter in 29 states, in US. And we actually analyzed, data for 20,000 businesses in first 6 weeks of 2013 and 2014, because we get a lot of their financial data because we are synced into their bank accounts, into their QuickBooks, into their, say, IRS data and everything else. And we actually started looking at that how, if the weather changes, how that impacts their cash flow and what impact it will create on their businesses, and whether it will be short term